Good morning to everybody. Great you could be here. So without further ado, let me introduce the two experts who are going to call on this session. Firstly, friend Farah Jaafar-Crossby, the CEO of Labuan IBFC, and also my other good friend from Malaysia, Nicholas Yeo, founder and actuary at Nicholas Actuarial. Welcome to both of you. It's great to have you both here. I'm really looking forward to this session. The first thing I think will be nice is to set the scene a little bit. I know Farah and Nicholas both have a couple of slides just to give an overview of what they've seen in the recent past. So perhaps, Farah, if we can bring the slides up for you, take it away.
Thanks, Steve. Right, so I'm going to be taking us through these slides very quickly because slides are more boring than a proper conversation, which I hope we will have later, and I know we will. So this is a little bit about Labuan, established in 1990, really over the last, what's interesting about Labuan, and the slides are here for you to read, but what's interesting about Labuan is that the captive business in Labuan has been around for a very long time. But until about 6 or 7 years ago, it was very much focused on Malaysian corporates. So over the last couple of years, well, it started about 5 years ago, and definitely over the last couple of years or so, we've really seen a lot of traction internationally, regionally, definitely, and now more so internationally. So much so that really the premiums in Labuan, more than 65% as of end of last year, is now foreign premiums within the captive ecosystem. So Labuan as a reinsurance domicile is not new. We've been around for, well, since 1990, so we've been around more than 30 years, and we're home to more than 220 license holders within that reinsurance, risk management, self-insurance fraternity. So it's a huge ecosystem, and it has numerous licenses that really people can use for pick and mix, as it were, like in a candy store. We are fortunately still the only Asian jurisdiction to offer the protected cell company for insurance purposes. Yes, I know a lot of people know that there is a variable company in Singapore called the VCC. From a corporate point of view and a legal point of view, from a corporate structure point of view and a legal point of view, it's very similar. However, this corporate entity in Singapore is not available for risk management services and use only in Labuan is the PCC available. So we've been lucky in that sense so far. Our ecosystem of self-insurance structures are wide, as you can see. So obviously your pure, your single captives, multi-owner captives, group association captives, rental captives. So we have the master renter captive and the sub-renter captive, which is very interesting. And I hope to talk a little bit more about this later, about the difference between that and the protected cell company. Because one of the things we will discuss clearly will be that huge uptake for PCCs and cells, but also as a spin-off almost to that is almost a resurgence or a renaissance of the rental captives. So the MRC and the SARC. Next slide, please. So let's talk a little bit about the growth that we've seen in 2020. So I spoke about our reinsurance industry, 221 as of end of last year. I can share with you that actually it's grown already in the first half. In fact, last year we put on 8 new captives, and we put on 8 new captives in the first half of this year already, of which, let me get these numbers right. Yeah, so 8 new approvals in the first half of this year. 2 are captives, pure captives, and 1 PCC. And this is interesting, 5 MARC, SARCs. So that is something to consider when you're looking at the legal point of view with regards to owning the structure or not owning the cell. So types of captives, origin, obviously APAC is growing. We've seen quite a lot of interest now from Europe as well. I think if the diehards of you would have started earlier today with that fantastic panel discussion between Shiwei and Shirti. And what Shirti was saying about how a lot of European owners are now looking to to place their risk or your captive where the risk is not necessarily where the HQ is. And so we feel that there is a movement there, the type of captives, obviously others, but engineering, marine, and of course an increase in specialty lines. So really that's my quick presentation. Nicholas has got a slide that will follow this. So over to you, Nick. Thank you.
Thanks, Farah. So I think I just want to quickly elaborate on the cell captive. So normally when you see this core and cell spoke type of a graph, that's how a cell captive look like. So they all come together in a core. So it's a very unique corporate structure. So one of the key features of cell captives is that this is actually one legal entity, and so there's one calling to these several cells, and when it's on a going concern, actually cells have a separate assets and liabilities. So why would people do a cell instead of setting up a captive? It's always the agility. You can set up much more faster, and for cells, you can actually leverage on shared service from the core and lead to a lower cost. These are the generic advantages that actually applies to all the cells. Specifically, normally there are some tactical reasons as to why people put up a cell captive. Sometimes they want a specific access to alternative markets. These alternative markets can be the insurance markets as well as the investment markets. So to access to these markets, a special cell is being set up. It's also worth noting that having a cell, as opposed to having a captive, the accounting treatment is a bit different. The captive is actually a wholly owned subsidiary, whereas the cell is something like a deposit or investment, depending on which accounting jurisdiction you're under. So for some of the organizations, a cell may be preferable compared to a wholly owned captive. And sometimes for jurisdiction management purpose, because some large organizations, they have more than one captives, and some of them they have several cells in different jurisdictions, because each of these jurisdictions can help to serve a different purpose. I guess this is all I have to share in this slide. I pass it back to Steve to start the discussion.
Well, thanks very much. So earlier today we had a poll that showed that we've seen a lot of growth, and the growth has been shared mostly between Singapore and Labuan, and it's quite interesting, Farah, the breakdown of that you touched on. It's clearly there's been a big surge in the appeal of cells and the interest of cells, and I'd love to drill down into that a little bit. I mean, I've been involved in captives a long time now, probably coming to 20 years, and I should say from the outset, and I don't know, I've been accused of being in the wrong camp recently in LinkedIn, but actually I've always had the expression that a captive is a long-term, careful, sober, thought-through decision that nobody should rush into. And I've actually personally used the expression with CEOs and CFOs saying, look, if you put the right energy into this, then every 4 or 5 years it'll basically give you a year's worth of free insurance, because you're basically taking away from third parties roughly 20% of their admin stroke profit, which you're going to do yourself. So I've always had the advice, think carefully, take your time, make sure it suits the business, and then grow it steadily. Wow, is that all out of the window? I mean, the last 2 years, we've seen just a lot of people jumping in quite quickly. What do you have a sense of, guys? Is this driven by hardening markets? Is it driven by COVID? Or is it CFOs have finally woke up after 10 years sleeping and decided we need to have a captive, and I have thought about it properly. Farah, what's your sense of this? Is this a knee-jerk reaction? Is it a long-term sea change? What do you feel is underlying these new figures?
I don't know, Steve. I mean, at the end of the day, it's like everything else in life, right? So the truth lies somewhere in the middle. I think actually it is one of those massive confluences. Number one, I think it's pure and simple the democratization of self-insurance. I think it's gotten to the point where, smaller, medium-sized companies are looking at it thinking, I want one of those. Why can't I have one of those, right? Like everything else in life, I want one. I want one. That's one thing, right? And the other thing is also in Asia, you're looking at a lot of awareness. So, we do a lot of work. Labuan does a lot of work with Perima and a lot of other risk management associations across ASEAN and Asia. And it's about really, putting out that awareness. And then suddenly comes a hardening market. And this is like, 4 years ago, 4 years ago. And then the hardening market comes in. And then you get whacked by COVID. And suddenly it's like this confluence of circumstances that just pushes the idea, the concept, the allure of self-insurance. And then on top of that, you have this, you mean I can have one of these things that's not as expensive and it doesn't take 2 years to set up, right? So I think it's a confluence like everything else in life. I think also that, yes, I think it's important to understand that the cost element in Asia cannot be underestimated, right? So there's probably an opening up for a lot of latent demand. A lot of CFOs, a lot of risk managers probably knew about self-insurance for the longest time. But it's always been quite expensive, and you have to set up a new subsidiary, you have to this, you have to that. So if we look at sales specifically, like training wheels, it's a great opportunity for the whole risk management industry to grow, right? And I think that is the reason we're seeing so much of it. It's a confluence.
Thanks, Farah. That's really interesting. Nicholas, you're right on the coal face. Seeing these setups, setting them up yourselves, heavily involved. What have you seen as some of the drivers? Do you think it's short-term hard markets, or is there this real confluence, and it's also there's some long-term thinking behind a lot of these vehicles?
I think I very much echo what Farah said, and what we have seen is roughly in line with what she has seen. I think basically in general the activity in captive space is just increasing. I think when you see the numbers coming through, those are the captives that are being established. There are a lot of organization conglomerates that have actually started to look into captives. They have actually not gotten to form the captive, or they have decided that captive is not yet for them right now. But certainly this trend is going to continue because there's this pipeline coming up. From what I see is that often the demand for the insurance and risk management. So this is why people are thinking about it again. Captives themselves can be structured to suit the changing needs, changing demands. The traditional insurance market sometimes, unfortunately, do not really cater for very, very specific needs in the market.
But let me sort of pick up on that. The traditional market sometimes doesn't cater to needs. That's a very polite way of saying that actually the traditional market is walking away from certain risks at the moment. I mean, that's the reality a lot of customers are facing. And I'd love to get some sense from the audience and questions from the audience and challenges from the audience on this. But it seems from what we talked about in the prep area that quite a few of these cells are being set up for single risks or specific risks, as though that's something that can't be catered for. It also seems that, well, let's be generous and say people are being agile and opportunistic rather than desperate, but some of this is happening really quickly in terms of compressed time scales. Could you talk a little bit about, with obviously without naming names, what are we seeing as single risks and how that's coming together? I mean, what can you say about your experiences, Farah, and then I'll come to you, Nicholas, as well.
Yeah, so in a way, it is almost the opposite of what you would normally consider the kind of holistic risk, strategic risk that's being put into a captive that then now gets put into a cell. So it's almost like a different animal almost in a way. What we've seen is very specialized risks. So there will be a specific line, let's say for cyber, let's say direct D&O is another line, right? I mean, historically, you've seen a lot of engineering, marine, stuff like that being put into a pure captive. These are not the lines that you'll be seeing into in a cell. Cells are almost like fast food, if you want, right? And this is where the agility of the jurisdiction is important. This is where the legal structure is important in order to ensure that everything is well catered to. I think that is the bit that we need to spend some time talking about, because the kind of risk that's being put in is a sign of the inability for the risk managers to access reasonable cover. Okay, and everyone knows what this cover is and stuff like that. But what's important to understand, what's important to understand is how do you then protect that risk, right, within the cell, the legal structure of the cell. I think that's important to understand, and that's important to discuss. The fact that the market is harder is one thing. The fact that I guess our license holders are getting, the risk owners are getting quite desperate is another thing. And yes, you're completely right. They have come to us and they've said, we need this done because they have sourced traditional markets or normal placements, can't get it through. And they're now probably looking at 1 month in order to get everything up and running, insert it in, and then run with it. So yeah, it is a little bit of a Band-Aid. But what's important to understand is a Band-Aid for a small cut. It's not a huge line that's being put in.
Are you seeing similar things, Nicholas? I mean, we talked in our prep about these almost feeling like SPVs rather than traditional captives. Has that been your sense as well?
Yeah, I guess it depends on the line of business, right? So if it's a traditional property type business, then it does not make sense to put a single risk into a cell because you lose the diversification. But for example, like what Farah is mentioning, like things like cyber and things, it is already across multiple lines and multiple risks, although we see it as a specific risk. So that in itself has some substance. But on the financial side, it does really work a lot more like the SPV, especially when the risks actually intersect with the financial markets, because you can't actually wait for an eternity to sell a captive and expect the captive to run for a long time when the financial markets are changing quickly. But at the same time, there are also people that think that let's put together a cell and for now, and actually we can actually put more risk into the cell and gradually become a multi-line, multi-risk type of cell, so similar to a captive. So there's nothing stopping people from using a cell similar to a traditional captive.
Got it.
Yeah, actually, Steve, I wanted to talk a little bit about that as well, because, a protected cell company you don't necessarily go into a protected cell company just so you can own a cell. You could own the core as well and have very clear different lines in different cells. It's not necessarily just a commercial core, right? It could be a pure core, i.e., the HQ owns that core and puts different operational risks within different cells. That's also possible because of the bankruptcy remoteness of that corporate vehicle of the PCC. So Section 130 of our Labuan Companies Act actually provides for the bankruptcy remoteness between the cells, even though the cells themselves are not legal vehicles. It's only the core that is the legal entity. right? So there are different ways to slice it, cut and dice it. But what Nicholas is saying is true. It isn't necessarily that you go into a commercial core provider and say, I want to sell just to put my DNO or my cyber risk in. You could look at a PCC and say, instead of a pure captive, I'm going to have a protected cell company with different cells representing different risk portfolios.
Got it. Got it. Do you know, I mean, I don't want you to sort of breach any confidences, but has anyone done that yet? Has there an MNC who's set up a cell for multiple lines or something like that?
Yes.
Yeah. Okay.
Yes.
Okay.
Yes. Yes.
That's quite interesting, isn't it? That's really thinking about the total cost of risk.
We've got license holders that have decided to aggregate their risk, not necessarily just based on risk, because what they've done is they've netted it off at a particular level. And then what they've done is they've looked at the FX risk and decided to put all US denom in a particular cell, or whatever in a different cell, or euro, I don't know. You know, so there are different ways the CFO can look at a PCC and say, look, I'm going to net off my risk at a particular level, depending on the type of risk I have across the globe. And then I'm going to focus on the FX risk and then net it off here and then contract it out via the premium in this particular currency as well. So it makes it a little bit more flexible. It makes it, I guess it depends on the risk and it depends on the entity.
Right, interesting. Time is racing away. We've only got about 15 minutes left, guys, believe it or not. I just want to give you a quick recap on the poll that you've all kindly filled in. So the question was, what is your view of APAC's growth as a captive domicile by the end of 2025? And we have options of 200, 230, and 260. 200 was actually the lowest. Only 20% of you or so thought it was 200. So you're all quite bullish. You're saying 230 is 40% and 260 is 40%. So thank you for your replies. That's interesting. I mean, Farah, you'd prefer to see 400 up there as an option, I'm sure. Maybe we'll get there one day. Let's see. But as long as we're growing, then that's a good thing. I would encourage the audience, if you've got questions, do stick them in the chat, and I'll get to them as soon as I can. But meantime, I just want to step back a little bit and talk about some of the differences between a cell and a traditional captive. When you have a traditional captive, the appeal, or one of the appeals, is you own it. It's all your baby. It's not someone else's. The reality with a protected cell, a sale of any sort, is it's someone else, and you're putting your trust and faith in that other company, and you're giving them a bunch of money, and you're hoping they're going to do the right thing, and you've got your fingers crossed. What are the considerations that a risk manager should be thinking through as to the differences in that situation? Nicholas, maybe you could go first on this one. What should a risk manager think about with a cell compared to a traditional captive? What are the extra risks, or is it immaterial?
Thanks, Steve. So I think there are a few considerations. Some risk managers internally have significant amount of expertise, and with this expertise, they actually can go on to form the captive, and if they would like to make use of their internal expertise. But some organizations simply do not have a lot of insurance knowledge within the organization, and they will struggle to manage a captive from the first day. So from this aspect, if you select a professional cell provider, to a certain extent, it actually helps a lot with expertise. It mitigates a lot of the operational risk involved in running the captive. Having said that, essentially it translates into some sort of third-party risk where you're actually outsourcing quite a significant function, which is your risk management and all your procurement of subsequent risk protections. and there are some worries that that money might get lost if the cell provider actually absconds. But at the same time, the legal aspects needs to be clear so that everyone is protected, and there are ways to actually minimize all this sort of counterparty risk and credit risk legally and also operationally. I guess overall, at the same time, the cell providers are also regulated in each of their jurisdictions, so they are also subject to certain standards and compliance and things like that. So this is, in the overall, not a very significant issue, but nonetheless, of course, this concern exists.
Thanks, Nicholas. Farah, you, as the regulator...
Farah mentioned that there's like this bankruptcy remote provision in Labuan. This provision is not actually in everywhere in the world, so people shouldn't take this for granted as well. This is one important protection that actually the Labuan cells have.
Understood. Farah, anything to add with your regulator hat on to what Nicholas has said there? I mean, obviously, instability of this type would be a huge problem. So I'm waiting for you to say you've got this covered and everybody can relax.
We've got this covered. Everyone can relax.
Awesome.
No, seriously, I think it's important to understand that the solvency requirement sits at the core. So like everything else, you need to ensure that they're competent. So the co-owners are competent, both from a company secretarial point of view, because you have to remember that a protected cell company is a corporate vehicle. It's not an insurance vehicle necessarily. It's used to place insurance within, but it's not it's a corporate vehicle. So it's important that whoever is your core provider, in the event that you do go to a third-party core provider and don't set up one of these vehicles yourself, that this is a strong core provider that has insurance management knowledge within that jurisdiction, first and foremost. Secondly, they have to be very solvent, because that is assessed. So Labuan FSA will come in and assess solvency twice a year with the core operator, the commercial core operator, right? And the commercial core operator will have a solvency and agreement with the cell, right? To see the kind of exposure. So it is like any other relationship. There has to be understanding between what the cell is looking to do and the kind of cover the cell is looking to do, and what the core can absorb and what the core is happy to manage, right? Both from a secretarial point of view and also an underwriting point of view, right? So I think that is key. And I think maybe in a way, right, and I'm not an expert, but in a way that kind of also dictates the kind of risk that gets put in a cell. Because a cell can never have a holistic risk profile. Because you are, if you're going commercially to a core, limited by what the core can absorb, right? So it's logical in that sense. But I think trying to understand the size of the provider, trying to understand the shock absorbers of the provider, making sure the provider understands your risk profile and how far you want to go, how much you want to retain, what your lines are, whether it's a long tail, short tail, how long you want to keep it open for, as it were. That kind of discussion has to be had with a co-provider, and once you're comfortable, then that's the way to go. As far as the regulator is concerned, everything will be managed at the core, and the core will have to report through to the regulator, the cells.
Okay, cool. So questions are starting to come through from the audience, so thanks very much for that. So let's tackle the first of those now. Nicholas, perhaps you on this one first. Can you comment on the cell's ability to write D&O risk, specifically for side A? Directors and officers always thought of as a little bit of a, not a problem child, but something that can be a bit more challenging than normal. What would your view be about directors and officers insurance in a cell, Nicholas?
Okay, I guess it depends on how the cell is structured, right? So if it is one company and it has only one D&O policy, then this D&O policy is really high severity type of risk. But if you are talking of this is a multinational and it has D&O from all the countries put together in the cell, then this is a relatively diversified type of risk. But most importantly is that I would say I've not actually seen many cells that fully self-retain all the risk in the cell. So the reinsurance still happens after that. So as long as the cell is adequately protected based on its capital and its retention, then I think that there's actually no problem of putting in any risk into the cell. I mean, having said that, cells and captives is just another way to manage risk, right? There's never a guarantee that there would not be a large claim that would make the cell and captive go bust, right? It's just about risk management. So I guess, I mean, my philosophy is you can always put anything into the cell, but the cell must have a certain risk appetite, and then it must be something that is manageable. The type of risk is not so relevant, but to the extent that if the reinsurance market thinks that they are not so comfortable insuring a cell compared to insuring a third-party insurance, I think may come into play. So it is possible that a cell will get less reinsurance capacity compared to a third-party insurance company that has other D&O in the books.
Sure, thanks. Anything to add on that one, Farah?
No, but I'm actually quite curious because in a way you said earlier, and I know for a fact, like one of our the largest captive we have in Labuan, for every 5 years you get 1 year free, right? Basically. So it's like a 20% savings on premiums for each pure captive. I'm not referencing this D&O question necessarily, but the thing that came to my mind is this: do you think a cell would also enjoy those kinds of savings? Is what I'm interested to try and understand, because it's, in a normal pure captive, there's a lot of risk management being put into it, right? And strategic risk management. So you're retaining certain stuff, you're putting out certain stuff. In a cell, because it's probably only 1 or 2 lines, how much of that savings can you make anyway, right? So that's something that I'm just curious about at the moment. It's just literally come to my head. With regards to D&O, yeah, I think it will probably be a very simple D&O line. I don't have any experience in placement or anything like that, I'm afraid.
Yeah, I mean, I've seen D&O in captives, and increasingly because of what's happening in third-party markets. So I think we're going to see more of that in future. I don't see any reason why a cell can't be as effective as a traditional captive in the way you described, Farah. If you're minimizing and internalizing the costs and essentially retaining the profit, assuming you don't have a bad year, then it should be the same sort of thing. One of the questions I know we definitely wanted to address, and we've only got 5 minutes left, unfortunately, because I've got about 20 more questions lined up. But can we say a captive cell is training wheels for a full captive? And can I just push a button, Farah, and turn my cell into a full-blown captive next week, next year, in 5 years, because now I want a full captive? Is that actually a progression, or is that impossible because these things are so different?
It all depends. Yes, there's conversion. The conversion is not that simple though, because the conversion, you have to understand. So I go back, and I hate to sound so legalistic in this particular session, but the cell is not an independent legal vehicle. The cell belongs to the core. It's the core that's the legal vehicle. So if you're looking at a situation where a cell wants to transfer into a pure, then you're looking at setting up a separate legal vehicle. Although there is history with the regulator with regards to the behavior of the cell, which you then can expect to replicate within the core, within the pure, it is still a new setup. And a new setup will take about a month in theory, but actually practically, because we're a bit backed up at the moment, it will take 3 months plus. Okay? The sell, however, there's no, you don't have to apply to the regulator anymore to set up a sell. It's just a notification to the regulator. This is very new. This was launched maybe 3 weeks ago. So now you just have to, you can set up a sell within a week with a bank account and all the rest of it and place it in. Also, don't forget that if you want to convert the sell into a pure, you're going to have to run it off. So it depends on the runoff as well, right? So whether you've got a short tail, long tail, how that works, and then how you're going to place it in. So, you know, it depends. But yes, it's possible.
Nicholas, is it something that you would relish from your position as the actuary in flicking this across from a sell to a traditional model?
I think this could be one of the motivation of setting up a sell, in the sense that at the time the cell was set up, there must be some stakeholder management that requires some compromise or some warm-up to say that, you know, we should not set up a captive because of reasons A, B, and C. So if this is the case, once the cell is actually set up, we need to address these A, B, and C reasons, right? Once these reasons are addressed, then we can actually form the captive and then graduate from this cell, so to say. I wouldn't necessarily think that this is required, because there's nothing from stopping the cell to continue to operate as it is, because aside from the legal structure itself, the cell and captive more or less does the same thing. And actually, if it was determined at onset that we actually want to become a captive, I also do not think that you need to go through this process to actually graduate to become a captive. I mean, one of the things is like potentially on the downside, there's like low exit costs of a cell, lower exit costs compared to a captive. But most of the time, the reasons to set up the captive, the cost benefit analysis will show that the benefits is a lot higher than the cost. So I think this part of the process is not necessarily required. But of course, there may be people that look at it this way and treat it, like you say, a trainer facility.
Interesting. And just one last question, because I'm interested in this. If we've seen a rush to sells, in part because of hard markets, if we see the world's governments keep printing money and inflation is going up, and interest rates stay low, arguably, as the insurance industry moves back into profitability later this year or early next year, there'll be a lot more capital coming into the sector again. We'll see a lot more capacity. Do you see sales then being shut down because people say, oh, okay, it's done the job. It covered me over those lean years. Now I can get the same policy for bargain prices in third-party markets again. I might as well shut it down. And will that have a long-term cyclical effect? Will it end up being some sort of balance against the, I don't want to call it frivolity, but variation in the third-party market, shall we say? Farah, some thoughts on that as we close, please.
I think it's about giving people a taste of self-insurance. I think, yes, as the market eases, there will be a reduction in the number of cells, especially the ones that are being used as a band-aid. But the ones that are being used as training wheels, those might then actually, the softer market might actually allow them the breathing space to set up a captive. Because like everyone else says, right, if you're going to set up a captive during a hard market, you've done it too late. Right? So if anything, it's a taster, it's like an entree. So it's not an entree, it's an appetizer. So what you have here is a situation where risk managers are starting to understand it, appreciate it, taste it, feel it, throw it against the wall, see if it sticks. And in a softer market, what you're going to have is the ability for these risk managers to go to their boards saying, look, we've had one of these things. It works. It's fantastic, right? It's a softer market now. We can talk to our reinsurers. Let me have the time to do this properly so that in the next cycle, when it's hard, we're going to have a proper captive, a pure captive for real strategic risk management, not just as a band-aid. So yes and no.
Okay.
Depending, right?
Got it. Nicholas, last word to you then. So if a traditional or pure, and I don't know where the word pure came from, but if a traditional captive is not just for Christmas, it's for life, can we say that a sale is just for Christmas and you can throw it away? And do we expect that to happen in the current, as the current market changes?
I mean, it would be great if it's Christmas every day, right? So I guess some cells are set up for a specific purpose. The purpose may no longer exist after a while. Some cells are set up forever. There's no expiry date. The cell does not go off automatically by itself after 10 years or something like that. I guess it is about feasibility of the ongoing feasibility of the cell or the captive or anything that you do to assess, and monitor the benefits and make it work for the long term. If we stop making it work, then it wouldn't be that around by the next Christmas.
Got it. Well, on that note, it just remains for me to thank both of you, Farah and Nicholas. That was a lively discussion in a few different directions. I enjoyed it very much. Thank you very much for your insights.